While everyone is busy arguing about the Algorand Foundation switching to a for-profit model, most investors are completely missing the single most important signal flashing on the weekly chart. We are seeing a technical setup that has not happened since the cycle lows of 2023. If you are purely focused on the governance drama, you are likely looking at the wrong data. The price is compressing into a decision point that will likely define the trend for the next 6 months. Today, we are going to ignore the noise and look strictly at the raw data. I'm going to show you why this move to the US is not random, how the institutional plumbing is being quietly connected, and most importantly, I'll share my exact algo strategy. Entry, stop loss, and take profit targets for this setup. Right now, Algorand is trading between 10 and 14 cents. It has been chopping in this range for weeks, and quite frankly, the sentiment is exhausted. You look at social media, and you see frustration. The price action feels dead. But dead price action is often where the smartest accumulation happens. We are seeing a classic compression pattern on the weekly time frame. The volatility is getting squeezed out of the market. Usually, when volatility collapses like this, it's followed by a violent expansion. The question is, which way does it break? Most retail investors are waiting for a green candle to buy. They want confirmation. But by the time you get confirmation on a chart like this, the easy money has already been made. We need to understand if the fundamentals support a reversal here, or if this is just a pause before lower lows. And the answer lies in a massive structural shift that just happened behind the scenes. Let's look at what is actually driving this asset fundamentally. I call this the Great American Pivot. For years, crypto projects ran away from the United States. They feared the SEC. They feared regulation. But look at what Algorand just did. On January 14th, they explicitly announced their move to the US is complete. They have a new board of directors, including the CEO of Abra and executives from MoneyGram. Why would they run into the fire while everyone else is running out? Because the fire is being put out. We just saw reports from Davos that President Trump is preparing to sign the crypto market structure bill. You have Larry Fink from BlackRock talking about tokenization. The regulatory environment in the US is flipping from hostile to welcoming. Algorand is front-running this. They are positioning themselves as the compliant, US-based Layer 1 ready for institutional adoption. This explains the controversy you might have seen on Twitter about them becoming a for-profit entity. Yes, people are worried about transparency. One critic noted that switching to for-profit avoids filing certain tax forms regarding executive compensation. That's a valid concern for governance, but from an investment perspective, it signals they are preparing for commercial deals, not charity. And the plumbing is already being upgraded to support this. We just got confirmation that Kraken now supports native USDC on Algorand. We also saw Albridge integrate Algorand, opening liquidity paths from Solana, Base, and more. This matters because institutions do not use bridges if they can avoid it. They want direct, compliant ramps. Native USDC on a major US exchange like Kraken is exactly what you need to facilitate institutional inflow. Now, I have to be honest about the yield situation. If you look at the current rates, DeFi lending on Folks Finance is paying around 2.3% APY. Meanwhile, centralized exchanges like Gate are offering over 5%. This is a problem. The on-chain yield is not competitive right now, which doesn't incentivize people to lock up their tokens in DeFi. That's a friction point we have to acknowledge. But despite that yield gap, the macro narrative is aligning. They moved to the US, they changed the board, they fixed the stablecoin rails. They are betting everything on this US crypto renaissance. Now let's look at the truth teller, the weekly chart. I'm looking at ALGO on the weekly time frame, and the structure is incredibly clear. We are in a massive compression wedge. On the downside, we have an ascending trend line connecting the lows from 2023. Every time price touches this orange dotted line, buyers step in. It's acting as a floor. On the upside, we have a descending resistance trend line coming down from the July 2025 high. This is the white dotted line on my chart. Price is getting squeezed between these two lines. We are sitting right at the point of control on the volume profile, which is at 11 cents. This is the price level with the most traded volume. It acts like a magnet. The market is comfortable here, but it cannot stay here forever. The exponential moving averages are currently bearish. We are trading below the 10, 21, 55, and 100. In fact, we are currently fighting with the 10 right now. We tested it, and we got rejected. That is why the price has pulled back slightly. We need to reclaim it to get any momentum back. But here's the indicator that caught my attention. Look at the Heikinashi RSI at the bottom of the chart. This oscillator has dropped into extreme oversold territory. The last 3 times it was this low were June 2023, July 2024, and April 2025. In June 2023, price rallied 204%. In July 2024, it rallied 421%. In April 2025, it rallied 111%. We are back at that exact same level. The indicator curled up, signaling momentum. But with this recent rejection at the 10 EMA, it's tipping down slightly. It's a fragile moment. But statistically, when this indicator hits this floor on a weekly time frame, the risk-to-reward ratio skews heavily to the upside. So, how am I playing this? I'm not guessing. I have a very specific plan based on these levels. I have established a load zone between 9 cents and 13 cents. This is my accumulation box. As long as we are inside this green box, I'm interested in building a position. We are currently sitting right in the middle of it. However, I'm not marrying this bag. I have a hard invalidation level. My stop loss is a weekly close below 8 cents. If we close a weekly candle below 8 cents, the structure is broken. That ascending support line from 2023 would be lost, and the probability of a flush to lower lows becomes too high. I would cut the trade there. That gives me a very defined risk. I'm risking a few cents of downside for a potential move to 20 cents or higher. For my take-profit targets, I'm looking at levels where there is historical resistance. My first target is 20 cents. My second target is 30 cents. My third target is 40 cents. If we get a massive breakout, I have extended targets at 60 cents, 90 cents, and even up to $2 for a small moon bag. But let's be realistic. The first major hurdle is breaking that descending trend line at 14 cents. Until we close above 14 cents, we are still technically in a downtrend. If we hit that first target at 20 cents, I'll move my stop loss to my entry price. This makes the trade risk-free. If we hit 30 cents, I move the stop loss to 20 cents. I trail the stop up to lock in profits. I never let a winning trade turn into a loser. The game plan here is simple. We are betting on a convergence. On one side, we have the great American pivot, Algorand aligning itself with the new US regulatory regime. On the other side, we have a technical cycle bottom signal that has historically produced triple-digit returns. The bear case is that the governance controversy scares away retail, and the 10-week exponential moving average keeps suppressing the price, pushing us down to test that 8-cent invalidation. The bull case is that the US legislation passes, capital flows into US-compliant chains, and ALGO breaks that first descending trend line, triggering a squeeze to the upside. Given the risk-reward ratio, buying at support with a tight stop loss is a trade I'm willing to take. I'm paying for the optionality of a trend reversal. To recap, I'm accumulating in the 9 to 13 cent range. My invalidation is a weekly close below 8 cents. My thesis is that the market is underestimating the value of Algorand's pivot to the United States, right as the regulatory floodgates open. The chart is ugly, but that is usually when the best opportunities present themselves. You don't get these risk-to-reward ratios when the chart is already pointing at the moon. If you found value in this data-driven approach, make sure to like the video and subscribe. It helps the algorithm get this data to more people who need it. Also, I share these charts and my updates much faster in my free Telegram group. If we break that 14-cent level, or if we hit my stop loss, I'll update you there first. The link is in the pinned comment. Go watch my previous video on Algorand, where I broke down the deeper fundamental changes in more detail. Remember, this is not financial advice. I'm just a guy on the internet reading charts. Do your own research, manage your risk, and I'll see you tomorrow in the next one.